It's time for bookkeeping, beer, and BS. Now, a couple things. Cory, I guess my question about, like, if you're exiting something, I'm trying to think of other scenarios where this would maybe come up, but if you do have a big, like, mid-year adjustment like that, is it worth looking into? Is there a process for it? Because my process was like, oh, shit, Cory, this is costing me a lot of money that I didn't plan for. Help! But not everybody has a Cory. So what would be the process, or is it just not even worth effing with?
Well, the big one is this. When you're going into your renewal, where you put all of your limits and exposures on a piece of paper that you're contractually agreeing to, understand what your plan is. Most of the time, you're not selling a company mid-policy without knowing that you were going to sell it before the policy term began. And if you do, it's at the very end of the policy, and you probably don't care that much about 1 or 2 months of payments that you're going to get back at audit time. For example, in your case, Dan, it was kind of like, hey, we think we're going to do this. You mentioned it to me. I said, cool, keep me apprised of the situation. And then we go into the renewal and we say, hey, let us know what your numbers are. What are you expecting? What's your exposure going to be? And it was kind of like, well, this is what we have, and this is what we did last year, and keep it the same. And that's an okay thing to do as long as business is running as usual. If you think there might be a big disruption to your business, you might want to think about the numbers that you're giving to your agent when you go into your renewal, and maybe try to come up with a number that would work. You never want to have a huge audit premium at the end that you owe, and you don't want the insurance company to hang on to a ton of your money and have to give it back to you. But try your best to say, hey, I think there's a decent chance we're going to offload this 4, 5, 6 months into the policy, so these are the numbers we're going to use. The insurance company has to agree to it, but if you get ahead of it, then you're able to set those policy limits, have a lower bill, and just understand that if you don't get rid of that business and you run it the way you normally would, you might have a significant audit premium at the end of the term. Yeah,
and I mean, the timing of mine was hilarious. I mean, we had just renewed, and then I was like, okay, and now this one sold, and then this one sold. Now I'm going to sell this one, and the timing of it couldn't have been worse, because I remember going into that being like, hey, like, we're going to try to sell these things, but we have no idea, right? And then, like, shortly thereafter, I'm like, oh yeah, this one worked out. Oh yeah, this one worked out. Oh, we found a buyer for that one. Oh shit, I got some big.
Now, Dan, you did get a little reprieve on all of that, correct?
I believe so. I mean, it's like the last 2 bills that I've seen have been low, and I think one was like a credit, but then I think the other one is just like, here's the new baseline, I think. Right. So we'll see.
And my point is, even that doesn't happen. We obviously got involved and said, hey, this customer doesn't know what he's doing. He's a little loopy-doopy, whatever we said, right? Can you please help us out?
You got to throw however hard under the bus you need to
throw. Right. And you don't mind at all. But my point is, you don't want to make your insurance agent do that. You don't want to have to spend the time internally on your own side to do that. And more importantly, you don't want to use any favors up in the industry until you really need them. And
maybe I'm jealous of insurance companies, because I sure shit wish I could stop working for somebody and have them keep paying me for like months on end.
Yeah. Well, it's one of those things though, where if you think about it,
So Cory, everybody agrees with that statement, but you.
No. I think all I was going to point out was there are actually some pieces to Dan's situation that wouldn't apply to somebody else. For example, Dan has an insurance policy that needs to keep going because he's got his other businesses on that policy. If Dan would have had an insurance policy for one company that was ceasing business because he sold it, he wouldn't have had an issue. So just to be clear, this isn't the norm. This was because of the exact scenario Dan happened to be in. He couldn't cancel the policy. All he could do was amend it because he needs the policy, right? And so I agree with you 100%. But remember, once you get a few other things mixed in with this, it becomes a bit more complicated. Then there's a certain way things need to be handled because he still has a contractual obligation in place for a policy that's still protecting his other businesses. That's all I was going to say.
Yeah, totally makes sense.
Yep. We're glad you're willing to understand it for us, Cory, because the rest of us are like, eh.
Yeah.
We don't want to understand that, and it doesn't sound fair.
I will say this. Exactly. Dan, what bucket did you say this fell into?
The fixed overhead bucket.
Cool. So let's call it variable fixed overhead bucket for a second. This is going to be my little tidbit about insurance, right? So a lot of times businesses want to relay what they're paying the next year to what they paid the year before, right? Everybody wants it to be a fixed cost for the most part, and it's just not. There are a few reasons for that. Number one, the market conditions. Right now, we're seeing 10 to 15% increases in property, and that's a good renewal. The property market is horseshit right now. It's very, very challenging. And at the end of the day, if you own a business, you're going to pay more in property than you did last year, and it might be significantly more if you've had claims. So you have the market conditions that can really make an impact on what you're dealing with in this fixed bucket. The second piece is not all insurance is created equal, right? I've said this on past podcasts, but your workers' compensation policy is not insurance, it's financing, and you will pay back claims at a much higher clip than you will on your general liability, property, so on and so forth, and your auto. But on some of those other property and GL and auto coverages, there are a few things mixed in there that honestly, most small business owners don't even realize. For example, and this is going to be funny because I'm going to put Dan and Dave on the spot. Ooh. Hey guys, do you have a wind or hail deductible on your property right now?
No clue.
Maybe.
It never hails.
Hold on. Wait. Let me ask my insurance guy. Yeah. Hey, Cory, do I have a wind or whatever else you said, a deductible thing?
You stop for a second. Here's my point, right? I'll get back to you on that, Dan. Here's my point.
I'll get back to you. Let me check all the fine print, folks.
Right. Here's my point. In the world of insurance, you have what you think you understand to be your traditional general lines of insurance, right? So if you have, let's talk about property for a second. Let's say you have a $1,000 deductible, pretty generic standard policy, and you have a $100,000 claim due to a fire, right? And you need to get that property fixed. You pay $1,000, the insurance company pays $99,000, right? The full 100 after you pay your 1,000 to fix it. If you have a 5% wind hail deductible on your property, it supersedes the $1,000 deductible. And if wind hail caused that $100,000 claim, you pay $5,000 out of pocket. So when you're talking about fixed costs, you have to understand how your program is built, because there's a chance you might get clipped with a $5,000 deductible on a small line item that nobody ever explained. You didn't understand if you had it. And at the end of the day, that might be the only way you were able to get property coverage. So my point is, you mix in all these different elements of workers' compensation through the experience mod being truly financing, different levels of deductibles and how they work and what can trigger something and not trigger another thing. And then just the fact that the market conditions can be astronomical in the world of property and cyber and all these different things that are blowing up right now. And that fixed bucket can be very vulnerable and very volatile year after year after year. And so I guess my message, it's not as much of a story, but my message on this is you really have to take the time to understand your program, what goes into it, and what's happening in the market and in your business. Because if you don't, things like Dan's scenario pop up. You might have a claim that comes and you go, wait a minute, I thought I had a $1,000 deductible. I don't have $5,000 to pay for this. Well, it's in the fine print, as Rob would say. So, it's just one of those things that you really have to understand if you want to run a successful program and keep that fixed bucket in, I guess I would call proactive status, not reactive.
Hey, what's up, business nerd? Thank you so much for tuning in. I hope you learned a heck of a lot watching that episode. Do me a favor, subscribe right down here. And if you really like what you saw, you got more goods right here. Check out this one or check out this one and do this. Go subscribe. Appreciate you. Work smarter, work harder, go earn yourself some pride. Catch you on the next one.